Hello and welcome back to Green Money Momentum, where we talk about market movements, making money, and money momentum. I'm your host, Trevor, and today we're going to be talking all about options trading. And it is, in my opinion, that options trading is the greatest financial instrument ever created. And over the last 6 months, I have seen some exponential gains from the strategy that I have been using. So I've seen return on investment percentages as high as 100%, all the way up to 1000% return on investment. And this has been consistent since December. So I've been seeing this basically every single day and every single week in the markets. So today I'm going to share that strategy with all of you and what I have been doing to see these gains. But before I do, I want to start out with this thought here. And I believe that there are two sides to almost all of us investors. We have the first side, which is the long, strong investor. We want to invest into plays for the long term, whether that be a year, 5 years, 10 years, 30 years. We have a long-term plan with what we're holding, whether it's stocks, cryptos, or index funds. We have that plan for long-term security. And so I think that's one part to most traders. But the other part, I believe, is the side of being a speculator. And so all of us want to be able to buy low and sell high, buy something when it's undervalued and sell it when it gets overbought. And so I think many times us traders will mix these two together, especially when holding shares on things we should be speculating on, because I know from experience, and I know I can't be the only one who's felt this, but many times you go into an investment speculating. You think, okay, I'm going to buy this while it's low, and when it rises up, I'll sell it. But then your play does rise up, and now you are left in a hesitant spot because you do have some return on investment, but you don't really know if you should continue to hold for the long term or if you should sell. And many times macroeconomic trends in the markets will change, or just overall sentiment shifts. And I know many times myself, with that thought, I'll buy something and then it'll reach a high, I'm super happy, and it starts to trail off, and I'll either cut my losses when I'm still in the green or cut it when I'm in the red, which is even worse because the mental exhaustion it takes to hold a play for so long, to check it very often, and then to see yourself down is daunting. I know in those situations, I will always have wished I would have sold. And well, that's where this strategy is going to come in perfectly, because with options contracts, when you do see a big pop, your return on investment will be very exponential, and you will almost be a fool not to sell, especially when I show you this strategy here. So first off, we're going to start out with, what is an options contract? If you don't know what an options contract is, what it is you are buying a contract to buy 100 shares of stock at a certain price, right? And so there is a premium to the contract. So for in this example, it's saying for this one contract, which is going to hold 100 shares, that the premium is going to be set at $3.60. And so with the options contracts, it's very important to remember this big number, 100 right here with the shares, and 360, because you're going to take these two, multiply them, and that's how you get the total premium for the contract of $360. So now we're going to go into the real options market and look at a play that I have been looking at. So we're going to start out here with BigBearAi, and Big Bear right now is currently sitting at a price of $3.65. And so if you were to purchase 100 shares of the Big Bear right now, you would get that for $365. But we could see here on the right all the quotes for all these contracts on the Big Bear, and we could see that it fluctuates at different spots. So right now, of course, again, like I say, it would be $365 to purchase 100 shares of the Big Bear. But in this example right here, this $3.50 call, ask price here is just 35 cents. So if you multiply that by 100, it's going to be just $35. So instead of holding Big Bear for $365, this option shows you that you could have the same underlying 100 shares, but for just $35 instead. And so this is where the first part of my strategy comes in. So the thing I want to put into people's heads more than anything is just because it's a great price doesn't mean that it's a great value. It's kind of like buying a car on Facebook Marketplace that is cheaper than everything else you see, and then you buy the car, you get it, and then it starts breaking down. Just because it was a great price doesn't necessarily mean it was a great value. So this indicator right now, with looking at in the money and out of the money calls and the value and price, will be one of the main things we look at with this strategy. We're always trying to find the best value for our money. What you will also notice here is that the in the money calls are more expensive than the out of the money calls. And so that is one thing to look at right there, is the ask price. The next thing to look at, this is huge, and this is what some may not know, especially if they're hopping into the options market blind, is yes, you do have your strike price, but the price that means a lot more here, the price that is more significant, is the break even price. And so with this contract right here, what it is saying is that Big Bear, with these contracts, they're expiring in 6 days. And so coming into the 6 days, if Big Bear does go above $3.83, by time of expiration, if you are in the money, you either have the right to buy those 100 shares at $3.50, or you could just sell it for the profit at that point. Now, if you get 6 days into the future and Big Bear is underneath that $3.83, this is where your contract could expire worthless. And so this is very important to note, because this is where some of the risk with options contracts does come. If you were to buy 100 shares of Big Bear at $3.65, it would be worth $365, and you could essentially hold that Big Bear for as long as you want. So if you go down on your position, you could hold. If you go up on your position, you could hold. But if you were to buy this specific contract, you only have till May 30th. And so at that point, that contract will expire, whether it is worthless or whether it is in the money. You're going to hope it's in the money. And this is where looking at the ask price and finding a good value is very important. Looking at what the break-even price is, that's very important. And then also the biggest part of my strategy is I am not buying contracts that are this close to expiring. So just 6 days from now, that would put me as an investor in a very risky position, because I can't tell you if Big Bear is going to shoot up to $3.83 in the next 6 days or not. But what I could tell you is I'm very bullish on the stock for the long term. So I don't mind waiting for that $3.50 call, say expire 118 days out into the future, right? So I'm going to go farther out into the future, and now we can see that the ask prices are a bit more expensive, but this is because the risk isn't as present as the calls that were just set to expire in just 6 days. And so it's so funny with Wall Street bets, where you see most individuals absolutely just burn their cash, is they will do one of two things. Typically, they'll purchase contracts that are just about to expire, and they'll go far out of the money to do this. So right here is a showing that the price is great, the value is not. A 10-cent contract, well, it is that for a reason, because for Big Bear to jump from $3.65 to a break even of $8.01, that would be quite the jump. So in this situation, you are turning your investment more into a gamble. I almost look at that kind of like gambling on sports. You're buying a lottery ticket. You're buying a team that is down by 30 in the third quarter, hoping that they're going to make a big comeback. And so you could put down a little amount of money and make a lot of money if that bet does hit, but it is very unlikely. And this is why we are setting ourselves out farther into the future, because again, Big Bear to $4 this next week, hard to say. Who knows, right? But Big Bear to $4 maybe in a couple months, a lot more possible. And so that is why the options contracts are also priced more. And so where my main strategy has been coming in these last couple months is what I have been doing is I've been looking at these small market cap stocks. If you don't know what that is just companies with a market capitalization totaling ranging between 250 and $2 billion. So stocks with a smaller market cap, that's why we have Big Bear on screen here, because it is just at 1.6 billion. And so the reason why we have been choosing these stocks is because they are typically at a lot lower of price, and then because of them having a small market cap, a little bit of momentum or hype can seriously skyrocket these stocks to the moon. And so these small market cap stocks will typically have lower ask prices. And so with Big Bear, we see options that are 70, 75 cents, 90 cents, a dollar. If you were go to something bigger, like say Tesla or the S&P 500, the SPY, or Microsoft, you will see contracts that are up in the thousands of dollars, right? And so with these smaller market cap stocks, you could bet what is not too much money essentially for potentially a massive return on investment. And so I will go about 6 to 8 months out into the future. I will purchase something also close to being in the money. Here's another part of the strategy. If you are going to invest, the further out you go out of the money, the harder it is going to be for your contracts to reach that price. So if you are purchasing further out into the future and then close to where the current strike price is, the stock has a greater chance to get to this break even spot right here. And so this is what is so mind blowing to me. And this is actually what changed my whole life forever. So this word right here is intrinsic value. And this is how the options contracts really move here. And so again, we're going to go back to this example of BigBearAi. So we're looking at an expiration of September 19th. We're going to look at this call right here, the $4 strike price, with the more important number here being $4.98. And so if Big Bear does get to $4.98, this is when the intrinsic value of its stock will start to rise. And for a call option, what intrinsic value is the stock price minus the strike price. And so if the stock price is less than or equal to the strike price, the intrinsic value is zero, as it would not make sense to exercise the option. And so this is where the life-changing return on investment comes in. Right now, this is worth $1. And so if Big Bear were to get up to $5.98, just as this calculation says here, the stock price minus the strike price. So every single dollar that it rises up is another dollar that the options contract gains. And so the stock goes up $1, so does your options contract. And this is where it is so appetizing, especially on these smaller market cap stocks, because right now, looking again at this expiration out in September 19th, if we start to see the stock gain dollars at a time above $4.98, our contract will also gain $1 at a time. And since right now this ask price is just at $1, every dollar that the shares go up, every dollar that the options go up, well, is another 100% return on investment. So on screen here, we have an options contract that I am currently in. This is again BigBearAi. This is for September 19th. We could see that I have an average cost of 78 cents, and these were bought not long ago. So this was bought on just 5.9 15 days ago, and now the current price is $1.15, right? And so the total return on this is 47%. So pretty crazy to see a 47% return on investment in just 15 days, especially when we compare to how the stock has done in the last 15 days. And so in the time when I have made 47% return on investment, the stock itself has just gained 18% since that same moment of purchase. And so the reason why this is so significant is the contract itself hasn't even reached to break even yet. So by just buying a contract that was set further to expire into the future and being just slightly out of the money, we got a good value at 78 cents. And now the stock price, along with this options price, is growing in value. And so if this contract does reach up to that $4.30 and beyond, that is when we could start to really see that exponential return on investment. Because again, think, I just bought this contract for 78 cents. So every time the stock goes up $1, that's more than 100% return on investment in this play here. So this is the strategy that I have been using, that I have seen a lot of return on investment with. As you can see, it is a very simple strategy. With options, it goes very deep. So this is just one strategy that we were looking at, long bullish calls, but it goes so much deeper than that. There are so many different strategies out there, and ones where you could hedge your bets, you could bet against the market with puts. So there is just an endless amount of possibilities in the options market. But this strategy is what I have been mainly sticking to, because as you can see, I take this as a swing trading strategy. And one thing I almost forgot to mention is you don't actually have to hold these contracts till expiration. So yes, I have till September to fight out the volatility, to fight out some flat days in the Big Bear. But if I see the Big Bear pop anytime into September 19th, and if I get to that level of being in the intrinsic value territory where the stock price is above the break-even price, when I start to see that exponential return on investment, I could at that moment decide just to exercise my contract and take those 100 shares at that discounted price, or I could just sell it for that profit at that moment. And that is usually what most options traders will do, is they'll just buy these options while they are low and then sell them at a higher price, kind of moving it around like a hot potato. This is where trading versus speculating, this is where I feel like most speculators will benefit greater from the options contracts. Because again, if we're just speculating, wanting a stock or a play to rise up to a higher price to where we could sell, well, options contracts are perfect because you are going to see such exponential return on investment. And if you are up 100, 200, 300%, you will be a fool not to take some of those profits. So again, my strategy here is I purchase small market cap stocks that have expiration dates at least months into the future. That is to fight any volatility along the short term. Where this strategy can blow up is if you start buying too many contracts that are close to expiration in the short term. You may win on some of these if you're buying contracts that are expiring in 5-10 days, but overall, that is more of a gamble. You are basically buying lottery tickets in that sense. Whereas if you are setting further out to expiration, still a little bit of a gamble, but it gives you a lot greater chance of actually cashing on your bet. The other thing I would recommend is with this strategy, this is the golden ticket. And it's funny because many things seem too good to be true, but this actually is. This is reality. You could double, triple, 10x your money in no time if you prepare yourself right. But the thing to avoid with that being said is don't get greedy. Above all, you need to be a rat with this strategy. If you see the volume uptick and you see 100, 200%, take some profits. Maybe leave a little bit in there for a moon bag for if it continues to rise. But if you see those profits 100, 200, 300%, take it. And then also with greed, just because I am showing you a good example here doesn't mean that there isn't a graveyard of contracts that have went the other way as well. And so that is where the risk with options trading does come in, because again, we're looking at break-even prices, strike prices. If it doesn't reach that break-even price by expiration, you will expire worthless. And so you will lose all 100% of your money. Whereas opposed, if you just bought the shares, you would be down on that position, but you could still hold for the long term. But this is where trading versus speculator comes in, because personally, if I am speculating and I buy into some shares and then I go underwater 10, 20, 30%, sometimes it's more painful to hold that position than it is just to take the loss on the options contract and move forward. And with that, that is where also with this strategy, don't be greedy again and don't over leverage yourself. Go into these investments knowing that you could 1 to 10x your money, but also don't be naive to what market conditions could bring, because you could always lose 100% of your position. And this is where most Wall Street bet degenerates get it wrong, because they just eat these red candlesticks by buying options that are too close to expiration and over leveraging on position. This options contract strategy, I believe, is a serious wealth hack, but only if you stay disciplined and do it right. And so what I do to stay disciplined, I have a couple different pieces of paper here. So one, I have this, it writes down all my different options trades. I also have a little calendar that shows me my daily profit and how much I put into the market. And so I know that there are also all these different tools within the apps, but I don't stay as disciplined as if I put it on paper. So if you're going to go into this strategy, just have a lot of discipline with what you do. But that is basically my small video on how these options contracts have changed my life. I am super excited because all this last year, I have just been seeing opportunity after opportunity and just picking up crazy returns. If you really do make this strategy work for you, it can change your life. And I'll tell you, it changed my entire perspective on investing in general. So I just wanted to share the knowledge and the wealth. I would be curious to hear what everyone else has to say if you're currently invested in the options or if you're planning on investing into options after watching this video. If you don't follow along this channel already, we actually cover a lot of these small market cap stocks that have a lot of potential. And so we have been covering them all year. And like I say, we have been seeing a lot of big returns. So please leave a comment. Please leave a like and please subscribe to the channel if you haven't already done so. Thank you guys so much, and I'll see you in the next video.